Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So this video is the next installment in the Guru Investor series that we've been doing on the channel for a month or so now. This series is where I go and pick one individual investor for each video, and I basically go through and give my top 3 lessons from that particular investor that I've picked up personally. Now, the investor we're going to talk about today is Li Lu. Now, if you don't know Li Lu, he is a Chinese-born immigrant to America, a very famous value investor. He's compounded money at something like 30% a year over his investment career. We haven't had a proper update on Li Lu's performance track record as far as I'm aware for a few years now. So if anyone does have Li Lu's track record or is somehow involved with Himalaya Capital and happens to stumble across this video, I would love to see his track record and get an update. But as far as I know, it's somewhere near 30% a year, which is frankly probably the best performance track record over a long period of time that I've ever seen. And that is one of the core reasons that Charlie Munger back here has put his money with Li Lu. Li Lu is the only fund manager that Charlie has ever put his money with. And that speaks volumes to Li Lu's both character and his investment prowess as well. So there's my top 3 lessons from Li Lu. I'm also going to leave a couple of links down in the description to a couple of talks that Li Lu has done over the years at various universities because I plucked a lot of my top learnings from those talks. So I'll leave links down in the description below if you're interested in checking those out. But let's get straight into it. Here are my top 3 investing lessons from Li Lu. Now, my first lesson from Li Lu is to fish where the fish are. And this is actually a Charlie Munger quote, but it's quite an apt description for how Li Lu approaches his investments. Now, go fishing where the fish are basically describes the hunt that value investors are constantly on for trying to find mispricings in the market. So Li Lu, just like any other value investor, is basically trying to buy something with much more value than the price represents. And in order to find those sorts of opportunities, you have to find inefficiencies in the market. So you have to find businesses that aren't particularly well understood, that for some reason are very mispriced. Maybe they're going through some sort of short-term event, and the general investor base in that particular market just doesn't understand the true value of that business. And we know that people like Warren Buffett and Charlie Munger have had a lot of success following that methodology in the US, but now there are a lot more investors in the US than back in the 50s or 60s when Buffett and Munger were really getting up and running and cranking out 30-40% a year type returns with their partnerships. And in the early days of Berkshire Hathaway, there's a lot more efficiency in the US market now than there was 50 years ago, just because information is much more available and there's a lot more people looking. So Li Lu has gone basically over to China to invest a large portion of his portfolio. Being a Chinese-born person, understanding the culture and being able to speak the language has been a massive advantage for Li Lu throughout his investment career. The Chinese market is not as competitive as the US market in terms of investors understanding how to value and how to price businesses and having that really create a lot of efficiency in the markets. So Li Lu has spent a lot of time in that particular hunting ground. So if I take that lesson on board for me personally, I have to start looking at markets and companies where I think I have an edge over the average investor. So, I look at a lot of US companies because I understand many of them quite well, but also because I get a lot of investment ideas from things like 13Fs and I follow a lot of American investors. But a lesson out of this for me from Li Lu is to start looking in my own home turf a little bit more. So look at the New Zealand market, look at the Australian market even, and also look at companies that are squarely in an area where I have an edge over the average person. So for me, that's looking in agricultural businesses, companies that operate in that sector. I feel as though I have a strong edge over the average person. So that is lesson number 1, fish where the fish are. Focus on areas of the stock market or areas of the world where you're going to be more likely to be able to understand a business better than other people, and where you're going to be more likely to find those dramatic mispricings in order to make great investments. Now, lesson number 2 from Li Lu is to be right on the big ones. Li Lu was giving a talk at Columbia, I believe it was, and someone asked him about investment mistakes. And Li Lu came out and said, you know, he's made a bunch of mistakes. Lots of investors have made mistakes, and he's no exception to that. But he really said throughout his entire investment career, he's never really ever been wrong on a big position. If he's ever gone to the point of putting 10, 20, 30, 40% of the portfolio into a particular stock and running a really big percentage of his net worth in one business, he's never really had those types of investments fall over, because frankly, he doesn't get to that level of conviction without being basically certain that he's going to be right. And the positives of this may seem fairly obvious, but I think it's important to remind everyone of kind of the maths around losing money and why it's really, really important to not break Warren Buffett's rule number 1 of don't lose money, rule number 2, don't forget rule number 1. That's exactly what Li Lu's talking about here, with never been wrong on the big ones. If you make an investment and it goes down 50%, in order for that investment to get back to par, it has to double. And it's not easy to find investments that are going to double. And that simple maths is a large reason why long-term performance track records can really be damaged by losing money. So Li Lu here is basically saying that if there is a significant chance of you losing money in a particular investment, it should not make up a really, really large percentage of your portfolio. And if you really are confident to an enormous degree that you're right on a particular business, well, in Li Lu's words, you can do this.
So, I put a shitload of well, the next 2 years, this damn thing went up 7 times. And the truth of the matter is, during all those time, it was propelled by earnings. And so during all this time, you still did not have any risk. It's not like you're hiding, writing some technology company after they doubled, tripled. You expose yourself to a huge amount of attacks. It was never more than 15 times earnings, never.
Now, my third and final lesson from Li Lu is that the risk of any given investment is directly related to the price that you pay. And he gives this example of investing in Russian oil, which sounds like a rather dodgy investment, investing in a part of the world where there's a lot of uncertainty, and investing in an asset class being oil, a commodity where there is also a lot of uncertainty. But what you can do as a value investor is search for something we call a margin of safety. This original idea from Ben Graham, that if we can pay a price that is less than the intrinsic value of a particular class of assets or a particular group of assets or whatever it is, then we can go a long way in protecting our investment and protecting our downside. So Li Lu gives this example of Russian oil. In the early 90s, Russian oil businesses basically became a free market almost overnight, as he described it. And you had a lot of people with these basically stock certificates, ownership in Russian oil, and they didn't really understand what they were or what to do with it. Now, something that they did recognize quite clearly is cash. So when people went out and offered, these Russian individuals with their new stock certificates cash in exchange for that stock, they were more than willing to hand that stock over in exchange for cash, something that they knew what they could do with. And this created a lot of mispricing in Russian oil. So extreme, in fact, that if you looked at just the balance sheet, so forgetting the earnings engine of these particular businesses, if you just look at how much proven oil reserves this particular business had, you could buy the oil assets of that company for 1 cent on the dollar. You could buy it at a 99% discount to the true value of that oil, assuming at the time $20 a barrel for that oil. So even though there was a lot of uncertainty around investing in Russian oil at the time, and there's so many unknowns that could happen, you were so well protected by buying at literally a 99% discount to asset values that almost anything could go wrong and you would probably still do okay. And in that particular situation, something quite dramatic actually did go wrong. So through the 90s, after you maybe invested at a 99% discount in these oil assets, we had the Asian financial crisis. And during the Asian financial crisis, Russia devalued their currency by 90%, a massive currency devaluation. In other words, if you had the equivalent of, say, 100 New Zealand dollars over in Russia, basically over that devaluation period, when you brought that money back to New Zealand, you're only getting about 10 New Zealand dollars. So a massive currency devaluation. But if you bought all of those oil assets at a 99% discount to their intrinsic value, you still did quite well. So let's say that you bought everything for 1 cent on the dollar. It went up 100 times. It appreciated to intrinsic value. You then got devalued by 90%, and you went all the way back down to 10 cents on that initial dollar. You've still got a 10x. You've still got a 10 bagger even through this dramatic currency devaluation event, because you had such a massive amount of protection, such a massive margin of safety by buying at a big discount initially. So those are my top 3 lessons from Li Lu. Fish where the fish are, be right on the big ones, and always get a margin of safety. The risk of any investment is in the price that you pay. So I hope you enjoyed that video. If you did, please hit like and hit subscribe. Also, let me know who you would like to see next. Li Lu was a suggestion by many of you in the comments in the last video. So I hope you enjoyed that one, and let me know who you want to see next. So you can watch some older videos over there if you would like. Hit subscribe over there if you haven't already, and I will see you in the next one. Cheers.